and business analytics at RPI. Since the beginning of this competition, since the beginning of the competition 10 years ago, RPI has always supported this competition by either sending judges or sending a team. So we're really glad to have you with us today. And Sagi has a master's degree in economics, so he's the economist in the room. Thank you, Sagi. Then we have Bill Amorosa. Bill is the Vice President and Chief Officer of Operations at NYCT. Really delighted to have you with us. Bill was the first judge to accept our invite to be part of the judging panel. Hopefully you'll be coming back again in the future years, so appreciate it. Thank you, Bill. Next we have Mickey Chabda. Mickey is a senior consultant at Ipsos MMA. Recently he was recognized as the Marketer of the Year. And how many nominations? You said there were 3,000 something nominations? 3,600 nominations, so congratulations on that recognition. Mickey actually flew this morning from Michigan to be a judge here, and he will fly back later tonight, so really appreciate. Then we have Dr. Jongju Park. He is an assistant professor of management at College of Staten Island, New York. Thank you for accepting our invitation despite the last minute notice, so really glad to have you here. Thank you, Dr. Park. And last, certainly not least, we have Nika Peniston. She is the data science senior manager at Bristol Myers Squibb. She has also been a judge here several times. I stopped counting. How many times have you? Fourth, fifth, yeah. Every time there's a competition, like one of the first people I reach out to is Nika, and in no time she accepts the invite, and she's been a big supporter of our competition. Thank you, Nika. So the rules of presentations and Q&A is identical to the semifinal round. Each team has 10 minutes to present their work. Have not, so we'll be strict about the presentation time, so we'll stop you at 10 minutes. For the Q&A, we usually allow the judges to ask the question, so it might be a little longer than 3 minutes. The event is actually live streamed thanks to my colleague, Dr. Sayed Kazmi. Yeah, a round of applause for Sayed and his crew. And I believe they shared the link with all the participants if you want to share the link with your family members or friends. And the video will be available afterwards on YouTube, on our YouTube channel for the O'Malley School of Business. So without further ado, I think we are ready to start the final round. I'm going to hand it over to my colleague, Dr. Georgios Komistis.
Okay, thank you. So the first team that is presenting is University of Massachusetts Amherst. So you can come here. It's 10 minutes a presentation, 3 minutes for Q&A, 2 minutes after for transitioning period. Okay.
Thank you. Can use the microphone because of the live stream, so whoever's speaking can hold the mic. All right.
Good afternoon, everyone. We're the team 1 from Eisenberg School of Management, University of Massachusetts. And my name is Yelizaveta.
My name is Amar Sherwani.
I'm Anastasia.
And I'm Omer.
And today we are presenting you our findings on investment opportunities in OECD countries in phase 1. And later on, we're going to move to phase 2, where we focused on US and Germany specifically. So in phase 1, we explored the current public debt in these countries, as well as we looked at the primary factors that are driving increase or decrease in public debt. We also looked at the trends in public debt, and lastly, how does varying public debt levels affect the key economics indicators, such as GDP growth, inflation, interest rate, and unemployment in OECD countries.
So in order to answer these research questions, here's our step-by-step methodology that we followed. We started off first with data extraction. So we made sure that we used supplementary data set that was provided, as well as include some additional data like war information, just so we can factor in the geopolitical conflicts that occur between the OECD countries. After that, we performed data aggregation. So we compiled all the data sets and made sure that we standardized the formats across it with the help of Python. We then worked with a lot of visualization, so we created bubble charts as well as line charts to get an initial insight into the data set. And then we ran a couple predictive models. So we ran machine learning models like decision trees, neural networks, XGBoost, just to get a sense of what kind of performance each model is giving us. And then finally, we had our prescriptive model, which was a linear optimization model, just so that we can make a recommendation for Horizon development to enter a new foreign market.
So to begin, we have this animated bubble charts, which hopefully works. Yes, so each bubble represents a country. We're looking here at the size and the color. So the bigger, the redder the bubble is, that means the country took on more debt compared to its GDP, and changes with each year. And pay attention to Japan and Greece, as they are staying red and big the entire time for the 13-year period. So, yeah. So this line chart represents the average public debt condition over time for the OECD countries. Overall, the trend is going up, meaning there's more debt for the countries. They're borrowing more. Pay attention to the year 2019 to 2020. That's when COVID happened and countries began to borrow more to help deal with the issue. And since then, the debt level has been going down.
Now, as Amar mentioned, we ran a number of different models during our analysis. One of them being XGBoost, which is our best performing model. XGBoost had an accuracy of closer to 90%. And we discovered that some of the key factors driving public debt in OECD countries included the percent of the population that's urban, the GDP, trade balance, and the public social spending that each government would engage in within those economies. And so taking the insights from the descriptive analysis, the predictive analytics that we used in the machine learning models, and finally prescriptive analytics, namely an optimization model, we would recommend Australia as the country of investment for Horizon development. Just to give a brief description of what an optimization model is, it's a mathematical model that iterates through all the different possible investment countries, in this case, and recommends the best country for Horizon development to invest in based on asset returns. And we cross-validated this tool with other metrics, including credit rating, and the healthy debt to GDP ratio that Australia has. And potential alternative countries would also be Poland and Switzerland, because they have similar characteristics of strong credit ratings as well as healthy debt to GDP ratios.
So now, after we analyzed all this data, we are ready to move to phase 2, where we're going to be focusing on US and Germany. In this phase, we looked at the similar research questions. However, we also explored the primary drivers of public debt in these countries, as well as how do fiscal policy approaches differ between these two countries.
over here, our methodology has remained somewhat similar to phase one, but what we started with is data filtering. So with data filtering, we made sure to only include countries like Germany and the United States, but we also made sure that we include additional information like CLI to consider the stability of the economy, and we will explain further on what CLI is. We then did an in-depth visualization and analysis again using multiple different line charts. And then our approach here was more qualitative because we wanted to ensure and understand what were some of the fiscal policy differences between Germany and the United States. And then finally, we cross-referenced that findings and insights with a predictive model as well.
So this line chart helps us to compare the public debt condition for both countries. So we can see their borrowing activity as well as the trends. So United States and blue, it has the trend is going up. So meaning with time, United States is borrowing more, whereas Germany's trend is going down, meaning that they're trying to not take on so much debt as the time goes on. And especially we were looking at the time of COVID, so from 2019 to 2020, 2021, to see how countries have dealt with it. And as you can see here, there is a more dramatic spike as well as a decrease for the United States, whereas Germany has not as much debt they took on during the COVID. And while we saw how different the graphs are for the countries, we were curious and we were doing the qualitative research to see what the differences in policies are. And we found out that the differences are the debt policies that they're using. For example, the United States is using debt ceiling, while Germany is using the debt brake. So to help you better understand that, I'm going to give you an analogy. So imagine a car. That's Germany. The car has the built-in speed limit. So as much as Germany wants to push on the gas pedal, they cannot accelerate more than the limit. Whereas the United States, they can accelerate as much as they want, but there's police waiting for them at certain points, so they need to slow down and make sure they meet the expectation. So that's the definition of the debt ceiling. So the differences between the two is that Germany is less flexible and more stable because they have a certain limit that they cannot cross, whereas the United States is more flexible.
And also in this phase, we did some more predictive modeling. This time again using XGBoost because it was the best performing model. And this time we had a model accuracy of 91%. And across both countries, we saw that the key factors driving public debt was GDP, the percent of population that's in the labor force, as well as trade balance and the net migration to and from these countries.
So now just to quickly give you guys an understanding of CLI, it's basically the composite leading indicator. And the reason why we picked this metric to calculate our economic stability is because it factors in a lot of information like consumer and business confidence, financial information like stock markets, as well as labor market information. And that just really helped us to understand the relationship between debt, public debt, as well as the performance of the economy. So right here, our modeling and analysis showed no significant relationship between public debt with interest and inflation. However, we did see a negative correlation with public debt and CLI, showing that anytime there was an increase in public debt, economies tend to slow down and there's business bottoms and a slowdown in economic activity.
And so to make a final recommendation for whether Horizon Development should be investing in the US and Germany as it relates to commercial real estate, we recommend Germany to be the country of choice. And this is primarily because Germany adopts a more conservative approach when it comes to their fiscal policy by implementing a debt brake. And so when investing in an asset that's highly illiquid, namely commercial real estate, this would make sense for them to avoid volatility that we observe more frequently within the US economy. Thank you very much.
Thank you.
Thank you so much, University of Massachusetts Amherst. Now I'll turn it to the judges to ask some questions.
Okay, thank you so much for the great presentation, and especially because you explained phase one questions and phase two questions as well. So I appreciate that. So, but in phase two in master, I found you conducted qualitative research, but I did not find any specific things about from that qualitative research in your presentation. So could you please elaborate more on your qualitative research and how did you do and what was your result and how it impacted your recommendations?
Yeah, thank you very much for the question. So namely, for the most part, our qualitative research was observing more the differences in debt policy between the US and Germany. So as Anastasia mentioned, debt break within the German economy is focused more on putting a built-in speed limit when drafting annual budgets for the German government. Whereas in the US, they just have a debt ceiling. So it's like the car speeding up and then it has to brake all of a sudden when the police is on the road. And so that was the extent of our qualitative analysis, but we'd definitely be interested in researching more and investigating different labor policies, for example.
Thank you so much.
Thank you.
Good presentation overall. I have a question on the steps that you outlined. So step 3 was visualization and step 4 was predictive modeling. Can those be interchanged? If yes, how and why? If no, why not?
So the steps, they can definitely be interchanged. The reason why we went with this step is because since working with large data sets, we first wanted to put it in an easy and interpretable way. That way we understand what kind of story the data is already telling us. And based off of that, we can then run our predictive models and understand why it's making certain predictions. So that's why we chose this methodology. But like you said, we could have also interchanged it where we're running the predictive model first and understand what are some of the important features, for example, and then based off of that, we could run a more in-depth visualizations based off of those features.
And then you landed on XGBoost model where there are other models that you considered, and if you can just give one example why that particular model was eliminated and then you choose what you choose.
Yeah, so like another model that we used was multiple linear regression. But what we observed with multiple linear regression is that it did not perform as well on economic data, which typically has nonlinear trends. And we observed with XGBoost that it performed especially well on nonlinear trends. And we also observed that it had the highest accuracy rate among the models that we used.
One last question.
Sure.
On the GDP for US and Germany, let's say data was only for 2021. So in 2021, US went down by 4%. And Germany was up by 3.5%, so pretty much the same ratio. Would you still recommend to invest in Germany if it is only based on 2021, where US sees a decline of 4% and Germany sees an uptick in public debt by 4%?
So just so I understand, you're saying, should we invest in Germany and US in 2021 if US GDP went up 4% and then Germany GDP went down 4%?
No, so the public debt for US went down 4% from 2020 to 21.
Yes.
And for Germany, it went up 4% as per the slide that you have shown.
Yeah.
So if the data was only for 2021, would you stick to your conclusion that you need to invest in Germany?
Yes, I understand your question now. To answer your question, I would say that yes, we would stick with Germany. And this is primarily because with the debt ceiling in place, the US economy typically has more volatile swings in the debt. And so if we see like such a large improvement in the US, we wouldn't be necessarily like surprised by that because that system's built in place for the US debt policy. Whereas for Germany, we understand that they take a more conservative approach to their debt. And so while in the short term we may see not as good of a performance, we can expect that they'll correct course.
Okay, thank you for that answer.
Thank you.
Also the qualitative aspect of it. So thanks.
Thank you.
Good presentation. Question, in phase one or in part one, you mentioned Australia as being a healthy debt to GDP. You have a number of slides that show debt as a percent of GDP. Do you have a benchmark or an opinion what the healthy GDP is for comparative purposes? Were you able to form an opinion around that?
I think that's something we could look further into. But in terms of healthy, we described healthy as being a strong debt to GDP ratio. So countries that showed lower debt to GDP ratios, we considered that to be healthy.
But you didn't have a specific percentage that healthy cluster.
Yes, we did perform clustering analysis, but we're at this moment that's something we could look further into. And
Thank you so much, University of Massachusetts.
Okay. All right. So next team is going to be St. John's University. And the third team after St. John's will be Manhattan University. Check the slides.
Like in the middle. Otherwise,
St. John's first, it's St. John's now, and then it's Manhattan.
He put up the wrong one. I didn't do it. He put up the wrong one. Yep.
Good afternoon. My name is Brianna. This is Jonzo, Alina, and Joella, and we are excited to present our comparative analysis on the United States versus Germany, examining their public debt and their implications for investment opportunities. So this is what we're going to be covering today, and let's get right into it with our thesis. So after a thorough analysis, we concluded that the United States has a stronger investment market. This is driven by the government's strategic usage of debt to fund domestic investment opportunities, its robust economic recovery mechanisms, and the global dominance of the US dollar. In our analysis, our objectives were to analyze trends, policies, and economic indicators from the years of 2010 to 2023. Let's get right into it with our debt analysis. So initially, we benchmarked both markets against the OECD median debt to GDP ratio from 2010 to 2023. As you can see, the United States is significantly above this median, and there was a significant growth in debt from these years. Conversely, Germany is mostly below this median, and there was a decline in debt to GDP, of course, not including the spike due to the global pandemic. Now I'm going to examine some of the key policies that drove these trends. So for the United States, throughout the entire decade, there was several policies that essentially contributed to the rise in debt, especially during COVID. There was trillions of dollars invested into stimulus to respond to the pandemic, and of course, this did raise the deficit. But it is extremely important to mention that this was essentially servicing economic recovery and sustainability. For Germany, the most important policy to note is the debt brake. This was enacted in 2009 and implemented in 2016, and the debt brake essentially limits the systemic deficit to less than 0.35% of GDP. Germany, of course, did suspend this during 2020 to 2022 as a response to COVID and the Russian invasion of Ukraine. Germany also faced unique risks due to its EU membership, as in the early 2010s, it had to bail out other countries in the EU as due to the Eurozone sovereign debt crisis. I will now pass it over to John Doe, who will explore our modeling.
Thank you so much, Brianna. Now that we have looked at the general public debt trends of both USA and Germany, we would like to see how debt behaves over time, especially in times of shock. This is what's called impulse response function. So now you might be wondering, how do I read this graph? Imagine dropping a stone into a pond. The shock is essentially the splash, and the ripples that traject are the short and long-term effects of debt shock. So we see at period 0, globally in OECD, an initial response to shock is that one seeing that shock is real. And at period 1, so 1 year after the shock, 60% of the debt shock still remains. This shows that debt is persistent, it has self-correcting nature, and also implies policy implications. Now, this all justified our reasoning for our autoregressive distributed lag model, shortened for ARDL model. Essentially, we use this to find key debt drivers for both US and Germany. You could basically view this model as a very efficient tool in dealing with persistent dependent variable, which is debt, with persistent meaning it continues over time, and also any interest rate and inflation variable that could be lagged. So for the US, the key current drivers of debt were inflation and interest rate, and for Germany, it was actually the past debt levels. So since the interest rate and inflation rate for the US were one of the significant drivers of debt, we decided to do a comparison between interest rate and inflation rate for both countries. So from 2021 to 2022, inflation in the US rose, and the Fed raised the rate in 2023, and so inflation eased. This shows that the debt rises and inflation rises, also kind of justifying the lagged effect of debt and other independent variables. In terms of Germany, also 2021 to 2022, inflation rose due to global shocks, and this also showcases that Germany's past debt is increasing. Past debt is heavily impacted on the present debt. So bottom line for Germany, today's debt is tomorrow's reality, and for US, they are most affected by current shifts such as interest rate and inflation rate. So now I'll pass it on to Alida to talk more about policy implications.
Thank you, Janda. So we're going to talk about how fiscal policies generally impact the debt growth in different countries. We're going to start with a simple comparison, how different policies work, starting with the simple fiscal rules. If we're going to go back to the Germany and go back what Brianna mentioned a little bit earlier, they implemented the debt brake, which is 0.35% of the GDP, meaning they decided to step back, and instead of being a more risky, they decided to stay more substantial and more stable. Meanwhile, the United States, that has no legal limits regarding any deficits that they continue within the country, they have more opportunities to be more risky and invest into the markets that are just stabilizing or growing super fast. Another example can be COVID-19, when Germany decided to stay a little bit and more orientate to the European Union. America pulled trillions of dollars just to stimulate the market and make sure the economic growth is continuing within the country. Lastly, currency is very important for both of the country. If we're going to take a look at Germany, we'll clearly see that they use primarily euros, which is highly dependent on the European Union, as well as they can act at any monetary policies independently. Meanwhile, the United States has the dollars that happens to be the world reserve currency, which gives them the power of borrowing, as well as the implementation of using the dollars globally all across the world. As fiscal policies highly implemented in the short-term impact on the debt, it is important to understand how in the long term countries act and grow economically sustainable. In order to do so, we decided to evaluate economic stability based on the several factors. Prudent debt, which is not the amount of debt that your country has, but how sustainable it is. In a simple words, we call it a good debt. In Germany and United States, the number varies from 75 to 80% of the good debt that both have, which is very substantial and very sustainable for both. Another one is the political stability. We know tariffs are changing pretty quickly as of today, as well as the political relations. Moreover, despite the leadership changes within the countries, it is important to understand how long-term policies are impacting within those countries. Urban population and credit rating are global frameworks that helps us to see the global picture of each country and how it's going overall. Based all on the data that we gathered from the modeling as well as the research, we decided to pursue with the weighting model. So how it works, you basically assign a specific weight to each of the criteria, and at the end, you compose an investment score to both of the countries. As you guys see from this presentation, we assign a very specific weights to each of the criteria. The fun fact, they are not arbitrary. They are based on risk assessment based by IMF as well as the S&Ps. There are very specific numbers as well as the indexes that we gathered historically to make sure numbers are accurate. As a result of the simple calculation and multiplication, we realized that United States is overpacing and actually becoming in the first place between Germany, landing with 38 points, while Germany leaves us with 34 points, leading us with a strong conclusion that the United States, despite any changes that are happening in 2025, remains as a fundamental economic power within the world. And I'm going to pass it to Joella to talk more about how United States is playing on the ground.
Thank you, Alina. Now that we've identified that the United States is the ideal market to invest in, let's take a look at the specific opportunities driving this market. So on the industrial and logistics side, we've seen that there is double-digit rent growth. Additionally, we've seen that there are 4% vacancy rates indicating tighter supply and strong demand. For life sciences and biotech, we've seen that $40 billion of investment has been poured into this sector as of 2023. And additionally, overall office vacancies are 19% across the United States due to remote work, but for this sector, it is only 7%. As for multifamily housing, we see that Sunbelt cities saw 4 to 5% rent growth, which is above average, and cap rates between 5 to 5.5%, underscoring incredibly lucrative returns. Additionally, for data centers and AI, we see that global sales volume tops $6.5 billion, while industrial vacancies fell to 1.9%, again showing tightening supply conditions. So as we see, global capital is flowing into the United States. As we found, the United States ranks number 3 globally for sovereign wealth fund, following closely behind Singapore and the United Kingdom. As the world's reserve currency, the United States provides strong dollar dominance with global pricing power and foreign exchange stability. This informs our investment strategy that has been segmented in opportunistic investors and risk-averse investors. For opportunistic investors, we recommend a portfolio that's diversified between industrial for 40%, office for 20%, data centers for 25%, and multifamily for 15%. For risk-averse investors, we recommend multifamily for 45%, logistics for 35%, and life sciences for 20%. Finally, turning to industry reports, we've seen from Reuters as of late April that Germany is the only G7 nation that has had stagnant growth for the past 2 years. This is projected to continue also into this year as well. And finally, in the graph that you see on the bottom, this is from the Financial Times as of late April, which shows that the United States ranks far above Germany in terms of economic growth.
As Warren Buffett said, it never pays to bet against America. Thank you so much for your time, and we open the floor to any questions.
Thank you. I wonder, where did you get the data on the interest rate for Germany?
So this was part of phase 1. We had 19 data sheets that were cleaned, we merged, combined into one cohesive file. This was also applied from, thank you. This was also applied from the competition. Yes, and that was sourced from the World Bank. Yeah, so we didn't have to find it ourselves, if that makes sense, but that was the source.
Thank you.
Mm-hmm.
Great presentation. Question 1. So being a student, which loan is most common? Student loan for tuition or credit card, or A of that? Part B, what if reduced inflation or interest rate be most useful to get over student debt?
I can start with this. Obviously, interest rates are a figure that's directly related to the cost of borrowing. Obviously, you take out money, and the higher the interest rates, the more you have to pay back. So in the context of being a student, And, if you're paying back student loans, interest rates are more ideal because it just essentially makes borrowing cheaper. I actually think that's a really interesting point that kind of connects to Germany's fiscal policies because kind of on the graph that we had way back earlier, they had very low interest rates, yet their debt was still really low, which means that they could have kept borrowing for a pretty cheap amount, but they didn't, which goes to show just how strict and austere they are within their policies. So to answer your question, I think interest rates are definitely the most relevant when it comes to borrowing costs directly.
Does anybody from the group differ? So second question, in the economic stability slide, just before the pyramid, you mentioned about euros versus USD. So 1 euro is 1.13 USD today. Does that change the scenario or is it irrelevant?
Yeah.
Just before the slide. Just the last point.
Yes, so as of now, as of today, US dollar and euros are pretty tight just because of the tariff negotiations. US dollar has been fluctuating a lot. Nevertheless, we're putting a little bit more weight toward US dollars just because it's used as a world reserve currency. So that's kind of why we gave it the more weight, even though there's been years when euro actually weighted heavier than US dollars. But overall, they go $1 goes to like 1.1, 1.2 euro, or sometimes it goes to 0.97.
So the weight is on qualitative aspect then.
Yes, you're correct.
Just a really brief adding to that too. Sorry. Our commentary on like the US dollars versus the euro wasn't so much directly related to the value of the currency, but just more the policy implications. So like our point that we were making is more that Germany does not have direct control over the euro. That's the role of the EU. Whereas US, we have our own currency, so we can set our own monetary policy, and that just gives us more flexibility, if that makes sense.
Yeah, so the focus is on qualitative aspect then.
Yes.
Okay. One last question. On the investor strategy, you gave like percentages for different sections.
Mhm.
So what was the hypothesis or calculation behind getting to 40%, 20%, 25, and 15%? If you can walk us through that.
Absolutely. So higher allocations were given to historically long demand drivers. As we know, multifamily is a core tenet of the American investment, overall American investment. So that's why it's given a stronger weight because, again, historically strong returns. It's not questioned. But for ones that are newer.
Sorry to interrupt. So my question is, why 40%? Why not 35? Why not 45? What was the reasoning behind reaching 45, 40, 20, 25, 15?
Sure, that's why we use our weighted model. We also implied it here. So how weighted model works, again, you use all the risk assessment papers that are usually published annually. And based on that, you can run and see the frequency of repetitiveness of the word, for example, of multifamily use. How many multifamily investments were done in 2022, 2023? And based on that, you create basically dummy variables that show the frequency, how long and how much they're mentioned within the specific year. And based on that, you calculate with simple math and you receive the percentage.
So basically, this is backed by publicly available sources.
Yes, you're correct.
That's what I want. Thank you.
Thank you. Sure.
Good analysis and recommendation there. Any reason you didn't carry it to the next step and say with these allocations, here's a potential 5-year return based on prior averages?
Well, in 2025, making the next 5 years, especially in the United States, we are not the one who's going to pressure on which market to choose within the United States. That's why we gave the opportunity investor as well as the risk averse. In order to do deeper research, we might need to look more into the policies within the taxpayers that are within the United States, as well as more on the regions of submarkets, as well, for example, what states, if it's in New York, if it's more towards the East Coast. So that's definitely can be our next step in this research.
Good, thank you.
Thank you.
But one follow-up on the borrowing, I know you chose US versus Germany, but I'm curious, so you're saying that USA, you can borrow externally, whereas Germany has that, that bottleneck where they need to be able to borrow just from the euro. Do you think that's better? That US can just continue borrowing as much as they want, just keep rate increasing with that, versus where you just have like the limit? What can you decide?
Yeah,
sure.
That is an extremely important question, so I appreciate it because that is one of the key drivers of our analysis. What we concluded is that you're 100% right, that unlimited borrowing is a potential risk, but what the data has shown is that in times of economic crises, this gives us flexibility, whereas for Germany, right, the debt brake was suspended, so they could have taken out more money during shocks. However, because of these, like blockchains in place, it was a little bit slower, it was a little bit more difficult. So ultimately, if we were not able to spend trillions of dollars during the pandemic recovery, there just would have been an economic collapse. So this ability to borrow more is ultimately what saved us and helped us bounce back and recover. So you're right, there are risks associated with that, but ultimately just having that flexibility is one of our key strengths.
We looked into unemployment rates. So when we were conducting the weighting model, we needed a critical variable, which means it's not directly impacting Germany or USA, but plays a crucial factor on how the economy works within it. At first, we tried to utilize the unemployment rates to maybe as a critical control variable. However, it was not that strong. So we tried to associate other variables that can somehow be implemented towards unemployment rate. And that's why we came up with urbanization rates, because they are somehow connected to labor force participation as well as the unemployment rates, and somehow can also showcase us how it's working within the specific cities or regions within both countries. Thank you.
Thank you so much.
Okay, thank you, St. John's. So the third presenter will be Manhattan. And right after the presentation, we will have a short 10-minute break. Now, right before the break, I will announce the fourth presenters. Okay, so Manhattan.
Those ones. Thank you.
You go first, and then give it to me. Go ahead, Ben.
Hello, everyone.
I just thought that was sorry.
My name is Holly Ruggiero. I'm Susan Radler.
I'm John Carson.
And I'm Rory Giblin. We're here representing Manhattan University. So first, we want to do a high-level overview of what we're going to be talking about today. We want to start with talking about debt, so the factors that influence debt, comparing debt from U.S. to Germany, and talking about what influences debt and how that influences other factors. From there, we want to talk about the economic stability of both of the countries, kind of compare their stability of U.S. and Germany, and then talk about our overall findings and conclusion.
So while the United States and Germany are major industrial and service providing economies, they have stark differences in their debt policy, levels, accumulation, and most differently, structure.
So to find what causes debt, we did a multivariate regression, and we did them separately for US and Germany. So on the US side, the two main factors that cause debt in the United States are military spending and median age. The US has a very high military spending, causing them to go into debt very frequently. It's a big use of American money. As you can see, the two p-values. Both countries suffering a higher median age as time goes on. We saw in 2008, the median age was closer to 40, and then 2023, closer to 50 years old for the median ages of both. Germany has now a 14% of their population above the age of 67. Germany also has a high tax revenue, though. They have a higher tax revenue than the US, and this leads them to kind of have a lower debt than the US.
So let's break down the debt. On the left, we have the United States. Here, you can see three colors instead of the two for Germany. Those represent the debt categories. United States debt in 2023 reached $33 trillion, 90% more than Germany in 2023. is consisted of foreign debt, domestic debt, and different from Germany, intergovernment debt and intergovernment holdings. This is money that the government owes itself. Germany, on the other hand, does not. Germany is subject to Eurozone regulations. Any budget surplus is distributed amongst the European Union nations to pay for social services. Most of their debt is primarily held in domestic debt, with a small portion each year held in foreign debt. On the left side of the screen here, you might be looking at this graph. You might see some dots, some colors. We'll break that down for you. On the top in the orange, you see the United States and their debt to GDP levels. On the bottom, you have Germany. You can see the diverging pattern with the United States consistently increasing its debt to GDP ratio, consistently above 90%, and in 2020, during the COVID crisis, hitting nearly 130%. While Germany consistently decreases its debt to GDP levels again until COVID in 2020, where it had a slight rise to 70%. The one time the United States was able to lower its debt to GDP levels was past 2020. Under the Biden administration, the United States saw massive growth in GDP. Yes, the debt did grow, as we saw on the last slide, but the growth of the economy far outpaced the debt. On the right side, we just want to do one more comparison between the two. We have the GDP per capita versus the debt per capita. In Germany, the German people are significantly better off. The GDP per capita is consistently and significantly higher than the debt per capita. The United States, on the other hand, in 2012, for one of the first times in American history, the GDP per capita was below the debt per capita. The United States held more debt per person than gross domestic product.
One of the biggest things we focused on in phase one was this graph right here. This is OECD countries, all 38 OECD countries, which include very large countries and very small countries. But it's debt to GDP and how it relates to inflation. So categorizing debt to GDP in multiple different sections here, we can see that as your debt to GDP gets to those astronomical levels, those past 90% levels, we see inflation starts to rise and your economy starts to shrink. Now, the US past 2020 has reached those 90% debt to GDP ratios, but they have not kind of had the same effects that maybe those smaller other countries in the OECD has faced. So this is something that you might want to take a look at investing in the US, just because they are past this 90% debt to GDP threshold, where Germany is lower in the 50s and 40s.
So we decided to use a live regression to show the delayed effects of debt to GDP on inflation and interest rates. So in our regression, we found that for both countries, as debt to GDP went up, there was a positive correlation with inflation and a negative correlation with interest rates, with real interest rates. Germany tended to be much more conservative in their responses towards debt to GDP, while the United States had much more reactive responses. We can see here in our regression that the correlation was much stronger for the United States, and this could be due to their debt levels and their more flexible monetary policy.
So now we're going to go on and compare Germany and the US's economic stability. We use both quantitative and qualitative data to contrast this. So the first thing we looked at was the policy frameworks. We compared policies with German policies. The US policies take a very different approach from the German ones. They have the Federal Reserve that directly controls their interest rate and use quantitative easing. They also tend to broader fiscal relief, which tends to add to their deficits. Germany, on the other hand, has the debt broke, which means that they cannot borrow more than 0.35% of their GDP. They don't the European Central Bank. They have more of a targeted relief, and then they cannot raise their rates independently, even when their inflation is high. So now we looked at the qualitative metrics. So we took ease of doing business score from World Bank data. As you can see, the United States, which is in reddish color, ranks high consistently throughout the years,
higher than Germany. However, Germany is still stable and still ranks high. Next, we're going to look at rental yield all the way up to the right. Same colors here. In the United States is the darker red, the darker orange. They consistently rank above 4%, which means that there are higher returns. Germany ranks below 4%, but this means that they are still a stable economy to invest in, and they tend not to be as volatile as the US. Next, we're going to look at transparency and corruption. The US is above Germany until 2019, and then after 2019, Germany consistently ranks higher than the US, which is good for long-term investment. So now, looking at our quantitative metrics, we decided to make an economic stability score using standard deviation for 3 factors. We used GDP growth, inflation, and unemployment. The lower the score, the better, the less volatile that country is. As you can see, Germany ranks a little bit lower than the United States. And now we're going to look at these 2 charts comparing GDP growth and inflation. The US has struck in 2020 and 2022. They had high inflation due to COVID. And then Germany GDP growth versus inflation, they had a strike in 2022 due to the energy crisis, but then remained stable overall.
Next, I want to talk about one more. There you go. Next, we did a distance between all the OECD countries and the United States. So we want to see which countries are closest to the United States in a lot of investment data. So Germany ranked highest in this, mainly due to their high military spending. And then also we have standard deviation of a lot of the variables we used this year. So we saw that Germany was a lot less volatile in most of these investment statutes. So we can kind of see that they are not as volatile. Then we have some current events. The United States just lost their AAA accreditation. Germany is dealing with the energy crisis due to the war in Ukraine. They have a higher median age, and Germany also has a skewed trade relationship with China.
So overall, we found that Germany has a stronger and more stable economy. This is due to their debt management over the years, their economic policies, and improved business environment. Thank you so much.
Sure. Who's going to ask the first question?
Hey guys, one of the first slides, you showed something about the median age. Maybe it was like number 1, number 2. Yeah, I think this one. So what does it mean that the median age for Germany was not significant?
Median age for Germany looks like it's missing a 0. Median age for Germany is significant. It's under 0.05%. It was something that we found that was very important. It should be 0.03822. That would not be significant.
Okay.
So yes, sorry about that. The median age for Germany was significant. When the median age was rising, we saw higher levels of debt.
Okay, thank you for clarifying that. The other question was, there was some other regression that you did, and I think it was another table maybe. Yeah, this one. I think you said something about the relationship being stronger for the US. Can you show which one you're referring to?
Yes, so if we look at the regression, specifically the p-values, it was actually debt to GDP is really only significant for inflation and interest rates for the United States in our lag regression. We also ran a non-lag regression, and it was significant for both Germany and the United States. But we felt that the lag regression would be better to symbolize the delayed effects of debt.
So you ran 2 separate regressions, right? One for Germany, one for the US.
Yes, there's actually 4, so there was 2 for each country. There's 4 regressions. So
Oh, you ran inflation and interest rates separately?
Yes.
Why? Why?
So we wanted to look at how public debt affected inflation and interest rates. So we ran separate regressions for each one.
That's a multiple regression, right? You could have.
Saying there's two different regressions, regular regression and line regression.
Yes.
Each of them make equal.
Thank you for clarifying that too.
Uh, if you can compare unemployment rate to interest rate and inflation, the two metrics that you found from your regression are more prominent. How unemployment sits, if it is third, why, and if it is somewhere between them, how do you correlate that?
We didn't really do too much on unemployment rates in our project. Main thing about unemployment rate we found was that it was not significant in determining debt to GDP. And then from there, we were really looking at house prices for phase one. So in terms of house prices, it did not have a real significance.
Okay, and what was the hypothesis behind eliminating the data for 2020 to 2023 in the rental yield comparison or transparency, like the real estate rental yield comparison?
We used 2010 they stopped.
Okay, so it was a data issue, not,
Yeah,
okay, okay, thank you.
Thank you so much, Manhattan University.
All right, all. Let's do a short break until 2:30, and at 2:30 p.m. the fourth presenters will be St. Mary's College of California. because I
I'll
pressed
hold
that
it here.
link.
Okay, we can test.
Yeah. Should I? Okay. Okay. All right, everyone. So we're going to continue now with the next three teams. First team now is going to that will be presenting is University of Waterloo, right? Excuse me. St. Mary's College of California, and right after St. Mary's College of California, there would be University of Waterloo. Also, we changed the mics, so now they work perfectly. Please speak through the mic so that they can, whatever you say can be captured through the live stream.
Hi, everyone. I'm Renata.
Oliver. And I'm Luke, and we are a group of 4 business analytics and data science students from St. Mary's College of California. Our project title is Public Debt Analysis, comparing USA versus Germany. Our research question is, should Horizon Development continue investing only in the United States or expand to the German market as well? We used a total of 15 features, and most of our features were sourced from the competition-provided data from the World Bank Data Bank. And these features include inflation rate, FDI, unemployment rate, and tax to GDP. We also used a total of 2 indicators from outside sources, and these include Corruption's Perceptions Index, which was sourced from Transparency International, and average wage data, which was sourced from the OECD itself. Some limitations were that missing data were sourced from outside references, and that certain indicators considered insignificant are still of relevance to Horizon Development.
Methodology is as follows. First, we did a trend analysis of debt to GDP from the years 2010 to 2023, comparing the United States and Germany. We highlighted the key drivers of debt during these years. Next, we moved on to our modeling. We ran 3 different models and compared the results using debt to GDP as our target variable. For policy research, we looked at fiscal and monetary policies and also response to COVID-19, along with other economic factors. Next, for our scoring model, we looked at economic stability and then also the impact of our key indicators on debt. And then finally, for our result interpretation, we looked at the results of each country and connected to real estate implications.
Let's dive into our initial insights about public debt for USA versus Germany. We put out the debt from 2010 to 2023, and we labeled the most important points on this timeline. I want to bring our attention to 2020 in the COVID response, where we see that the US spikes to 117.1%, while Germany, their COVID response spikes a little bit, but it is pretty representative of their historical debt trends.
Next, to figure out how debt affects the overall stability, economic stability in each country, the US and Germany, we compared 3 models, the first being a linear regression, and then a linear regression with logarithmic transformation as well as texture boosting. And we found out that the linear regression with the logarithmic transformation performed the best with a R-squared value for the US at 0.96, and the R-squared value for Germany with 0.94. And the logarithmic transformation outperformed the other models for several reasons. The first being some of the predictors have widespread of data and they grew exponentially, assuming the linear trends, which the logarithmic transformation mixes, along with the standardized variable skills, reducing the dominance in magnitude predictors. And it also helped deal with panel data, adjusting to the rate of change in each of the factors. And it also helped meet the linear regressions by making assumptions of stabilizing the variables. And as we can see, it outperformed the other models in multiple areas, except for significant factors, but it outperformed the other models in the overall performance of it. And here we can see that for the US, significant factors that were driven by debt was corruption index, FDI, inflation rate, unemployment rate, tax to GDP. Well, for Germany, it was inflation rate, tax to GDP, wage, and unemployment rate.
Going deeper into our significant factors, we wanted to look at the economic stability and how debt affects these factors by modeling a 1% increase in debt and how that affects these factors. We see quite a variation in results, and that is for two reasons. If we think back to our initial insights on debt, we see that US has a more volatile and overall higher debt, while Germany has quite the stable line. So that represents these results, as well as debt is quite dependent on the actual policies that the governments implement in these economic areas, which Luke will dive into in the next slide.
Our research and results suggested that there are many key policy differences between the United States of America and Germany on public sector debt. First, for the United States, Congress sets the debt ceiling, and we recently saw this reinstated a few months ago in January 2025 after it was temporarily suspended in June 2023. Comparatively, Germany uses the debt brake, and this was introduced in 2009, and this limits annual structural deficits to less than 1% of GDP. And the United States of America is influenced by many schools of economic thoughts, including the influence of Keynesian economics and counter-cyclical policies, whereas in Germany, they're more influenced by ordoliberalism, and this is seen in social market economies and price stability. The Fed is in charge of monetary policy in the United States, and this is seen in high stimulus bills, and also the recent rate hikes in 2022. We saw the federal funds rate was increased by 300 basis points during that year. Comparatively, in Germany, the ECB, the European Central Bank, is in charge of monetary policy there, and they typically favor tighter controls in the United States. For expansionary fiscal policy, the United States favors high stimulus bills, such as the CARES Act. They also have a higher corporate tax rate of 30%. And excuse me, I apologize. The tax rate is actually 21% by the Tax Cut and Jobs Act of 2017. Germany is the one with a corporate tax rate of 30%, and they have a more fiscally disciplined approach. And for inflation and interest rates, the United States has seen higher interest rates, and this is affected by the lag effect. We've also seen a higher borrowing costs in Germany. Thank you.
During the last 2 decades, we've seen a lot of economic events that these countries have handled very differently. Starting with the United States, we saw recovery from the global financial crisis in 2010 and 2012. Using this as a dummy variable, we found a significant p-value of 0.04, along with negative correlation, meaning that relative to other years, the debt actually dropped these years. And this was because of budget tightening and stabilization from the previous years. Next, moving on to COVID, years 20 and 21, we saw a significant p-value of 0.01 with a strong positive correlation. And this was because there are far more cases and deaths in the United States than Germany, pressure on hospitals, and also economic closures. And because of this, we saw US sign over $5 trillion in COVID relief. Moving on to Germany, the Eurozone crisis and recovery from 2010 to 2012, we saw a significant p-value of 0.04. This was because Germany handled it a little better than other European countries, but they provided loans to these countries, which short-term increased the debt. We also saw exports slow down as the demand for their goods was increased a little bit. And then we saw mild stimulus to stabilize the economy. Moving on to COVID, we saw an instant p-value of 0.6. And this is because the universal healthcare system and unemployment protections that already existed before COVID, which made the transition a little bit easier. And then they also contained the virus sooner.
So what does our data tell us about Horizon's real estate investments and answering our original research question, should they expand to Germany? We believe that Germany is a debt-resilient country, which makes them attractive to Horizon because they have effective crisis management, debt brake, and tight policy controls. The U.S. is Horizon's more high-risk investment because of higher financing costs, increased market volatility, and high deficits. We projected debt increase in the U.S. until 2030 by 3%, and it actually falls in Germany by 3% until 2030. So Horizon will benefit with this global market diversification by investing in Germany. For next steps, we would research more construction data and real estate data, especially affordable housing data for ethical purposes. These are references, and thank you.
the presentation. Can you talk more about the projection through 2030 and
Yeah, so using our significant coefficients from our linear regression models, we plugged it into a Remax forecasting, and then using that, we projected into 2030, and then taking the average from 2030 minus 2023, we found those increases and decreases.
Good presentation. Just a quick slide back to the beginning. You mentioned 15 factors. Keep going. Right there, 15 factors, and you highlight 4. Did you discount the others, or are those just representative? And if those are the ones that weighted most, why did you choose those others?
So we used 15 of the 19 factors provided by the competition from the World Bank and OECD data. And then these were the 4 factors that were present both between the US and the Germany for how well they performed. But it's also important to note that interest rates were not significant like across the board for either of the countries.
Significant analysis?
In the regression model, so we scored the regression models based off of a p-value less than 0.05 and a VIF less than 10.
Thank you.
Yep.
A couple of slides forward. One more. How should I read the negative value?
So the negative values mean as public debt increases, these factors decrease. And it's a little confusing for the corruption index because it actually gives a top score for a bad score. So it's a little inverse. And then also unemployment rate, we saw negative for USA and then positive for Germany. And this is because USA has invested a lot of money, especially in COVID with stimulus, in helping the unemployment rate, which has made it go down a little bit with the rising debt. And then Germany hasn't done that as much, which follows the typical trend as when unemployment rate goes up, public debt does as well.
So negative corruption index means it's getting worse?
The corruption perceptions index is scored on a scale of 0 to 100, and 100 is actually a better score. It's considered less corrupt. And the corruption perception score, it's from Transparency International, and it scores based on how corrupt you're perceived. So 100 is actually a good score. So
that's worse. Going down, that means it's
good presentation. On this particular slide, so you have tax to GDP, then inflation rate, and unemployment rate present for both. So using these 3, or maybe any of the 2, can you justify where to invest, US or Germany? And then why do you say that?
We justify to invest in Germany because if we look at the stability of these significant features over time, that's what really is going to tell us if this is a stable investment or not. And when we did that, in our future slides, we saw that Germany was the more stable investment, and that's why we recommended it for Horizon's portfolio.
A follow-up question on that, let's say Horizon gave you 100 million, how would you put that? Like how much in Germany, how much in US, completely in Germany, completely in US, completely?
Well, I think it depends how risky Horizon wants to be because according to the phase 1, they're already invested in the US. So if they want to make a more high-risk investment, I would recommend putting more money in the US. But if they want a long-term stable investment, then I would tell them invest more into Germany.
In both scenarios, if you could give me a percentage split out of 100?
Yeah, so in our phase 1, we ran clustering. And we basically gave every country a debt resilience score. So looking at long term, if the debt is going to rise a lot or if it's going to stay the same. And we determined that a lot of European countries, including Germany and a lot of Northern European countries, were debt resilient and actually going to fall in debt going to 2020 or 2030. So from that, we would kind of diversify across all of those countries. But USA versus Germany, it's a little different.
Then if you can choose the percentage as well, so if you could diversify the.
I would say 70% for Germany, 30% for US.
Thank you.
So thank you for the good presentation, and please go to the last page before the reference. So I know that the next step is based on the scenario, but I'm just wondering the why. So you pick this kind of the construction and real estate prices that your first or your next step. And please elaborate more on the next step of your follow-up research.
Yeah, so we pick construction data because that is important to real estate for commercial and residential. We did try to find this data, but that was one of our limitations as it wasn't very readily available. So that's something that we would make more research into, whether it be qualitative or quantitative. And we chose real estate prices, especially for affordable housing, for ethical reasons, because we want to make sure that we're making investments that benefit the country as well.
Then would you please elaborate more on the research step for that?
Well, for phase one, we didn't have much access to that, and that's something we felt throughout the competition that would have really helped us if we just researched those areas more to better understand them in each of the OECD countries, specifically in this case, US and Germany.
Okay, thank you so much.
All right. So next presenter is University of Waterloo. And right after University of Waterloo, we're going to have some new parts.
Who wants? I like it. Yeah.
Could you just? I think it's good. Check. Checked in.
Hello and guten Tag. We are the University of Waterloo here to talk about phase 2, US and Germany debt from 2010 to 2023. We structured our methodology based on the following agenda. Our objectives were to understand debt trends, spending policy, and debt levels. We then wanted to look at the drivers of debt and the impact of this debt on key economic factors.
So throughout our presentation, we're going to be highlighting the key differences between Germany and US fiscal policy. Starting with Germany implementing a debt brake. This is focused on limiting spending as a percentage of deficit GDP to 0.35%. While this number can be adjusted during times of economic stress, it must be repaid as the economic conditions improve. With the US, they focus on a debt ceiling fiscal policy, which limits the amount of government borrowing at a certain time. Once the US reaches this debt ceiling, they are forced to renegotiate the ceiling, and this has been known to cause a little bit of economic uncertainty and has
caused some stir up over the as it comes up every few years. So we want to highlight some of the trends that have been happening over the time frame, starting with the great financial crisis and the economic environment that came thereafter. Now, this was an expansionary period, and during this time, Germany decided to first implement their debt brake system. This limited deficit spending to, again, 0.35%. However, during this time, the U.S. ran a constant deficit, which really grew their debt spending all the way up until 2017, where they performed tax cuts, which only increased spending more. Again, during the pandemic, spending increased again. However, as the economic conditions stabilized, Germany used this time to repay their debt before their debt brake was actually reinstated in 2023. Again, during this time, the U.S. continued to spend, growing the deficit.
So now that we know what the trend of debt is over our two target countries, we're going to look into what is actually moving debt to GDP, because that's what really matters. So starting off with the US, we performed an XGBoost analysis and then an explanatory model known as SHAP to explain the findings that we have from that. So starting off, we found that government expenditure was the strongest positive driver of US debt to GDP. And so this makes sense because the more you spend on government spendings, your debt to GDP will also rise with that as well. But something that was actually surprising to find was that unemployment rate was a negative driver of debt to GDP, the second strongest one that we had. And the reason that we found this is because if you break down debt to GDP into its two components, debt and GDP, the US likes to offer a stimulus when unemployment is rising. And so what happens is debt rises because of that, but also GDP rises because that money is going back into the economy. That's the only effect that's left over from canceling one of those two aspects is the inflationary effect of GDP rising because more money is in the economy. So moving on to Germany, we can see that unemployment is the strongest driver here. This is because Germany takes a longer-term approach to their unemployment, fixing their unemployment, and so we don't see immediate effects as we do in the U.S. So therefore, it's stronger, and we'll move on to government expenditures in the future slides.
Now that we understand what's driving the debt, we want to take a more granular look into government expenditures and really dive into what each country is spending and how it reflects their policies. Starting up top with the US in blue, we can see that the two main sections are health and social protection. This suggests them looking into programs such as Medicare or other social programs. Next from that was general public services. It takes a pretty large chunk and is mostly represented by paying off past obligations of debt. What this shows us is that US has a more short-term view rather than focusing on the long-term investments. Now, switching to Germany on the bottom, you can see that social protection takes up over 40% of their government expenditures. This goes in things like unemployment, benefits, pensions for families, things with a more long-term look. And then we move into health, where they focus on a universal coverage, making it affordable for the entire population. This differs where we can tell with Germany, they focus more on the long-term over short-term stimulus.
As mentioned before, we're going to break down what is actually happening with government expenditures and how is that actually attaching debt to GDP. So we performed the same analysis here, XGBoost followed by SHAP for explanation. And what we found here is that the US, their government expenditure is dominated by defense spending from a standpoint of affecting debt to GDP. And so when the US spends more on defense, their debt to GDP rises with that. This is likely due to military operations, whereas on the flip side, Germany also sees their highest influence on debt to GDP for government expenditures as defense spending, but this is actually a negative effect. So when Germany spends more on defense spending, their debt to GDP actually decreases as a result of that. And we believe that's because of their presence in research and development and selling those goods to other countries as well. So another one is education that's very surprising is because in the previous slide, education made up for a large chunk of US spending. However, it actually doesn't have too much of an effect compared to how much it actually takes up. And it does have a positive effect. And for Germany, we can see here that social protection made up 40% of their spending. However, it has a slight negative impact on the debt to GDP.
Once we understood the main drivers of the debt, we wanted to understand the result of fiscal policy on both the fiscal budget as well as their interest burden. We did this by looking at the fiscal budget as a percentage of GDP, as well as interest payments as a percentage of GDP. So what we found here is that having the debt ceiling allowed the US to continuously prioritize more spending, which led to continuous fiscal deficits, which over the long run increased interest payments. This was which reduced overall flexibility. As opposed to Germany, which implemented the debt brake, this allowed them to slowly get back to a fiscal surplus, maintain stability at that level, while at the same time lowering their interest payments, which again is better for reducing long-term fiscal risk.
And to understand how debt is impacting the economic stability, we ran a linear regression on the key features that we had identified. And we found that long-term interest, which is long-term government bond yields, actually has an inverse relationship with debt. And this is driven by investors' preference for US bonds. They aren't too worried about the government debt levels, as the short-term interest rates, as you see there, are actually independent of debt, as the Fed sets this rate and the Federal Reserve has shown a priority for their mandate over reactions to US debt levels. Another key variable that we saw was the government expenditure. It had a very strong positive relationship where government expenditure increases with debt. And this also led to a higher inflation rate and a lower unemployment rate as more money is put into the economy, rising prices, and investments are made to reduce unemployment. In Germany, we saw the long-term interest and short-term interest both had a positive relationship, a more traditional relationship, as risk is priced into the interest rates. We also found that inflation and government expenditure were indifferent to debt levels, as Germany had a strong monetary policy and showed fiscal discipline over the period. And then we also saw unemployment rate had a positive relationship. And this was because of the timing and restrictive spending, where they could not spend enough to fully address the unemployment issues.
Now, with the understanding of the overall macro effects, we want to get a look at the economic stability. How we did this was using the Moody's sovereign ratings. You can see on the left, it looks at economic, which is GDP, fiscal, which is debt, and governance, which is partnerships and relationships. In the bottom right, you can see that Germany outweighed US just by a little bit, even though United States was very high in the economic. This was reflected by negative fiscal score. And then to conclude, our recommendation is that we would like to find a country somewhere in between Germany and USA's debt levels, but if we had to make a decision, Germany would be the way we would lean. Thank you for your time. And please check out the QR code if you'd like to see an interactive model of our work.
Sharing also providing your QR code. In one of the earlier slides, you mentioned Germany was going to repay their debt. So I was curious if you looked at the population growth and labor force size, like, was that impacting the ability to repay?
Labor force wasn't something that came up in our direct analysis or our initial analysis. However, it is definitely a fair proxy that would make sense on why the debt to GDP. Right.
Yeah, so they did see some rises, but the key thing for Germany wasn't as much population or overall kind of conditions. They were just putting in very strict policies to restrict any additional debt, and that kind of allowed them to start paying it down and grow their GDP, although at a slower rate, greater than the debt level on top.
This is more maybe of a curiosity question of data sets that were available to you. A lot of focus on GDP and the unemployment rate. Were there any factors available around productivity of labor?
With our addition, we didn't look directly at productivity of labor. We figured that debt to GDP was a good way to show debt as a percentage of something over a nominal value. And then also unemployment just proved to be a big portion of the analysis, along with government expenditures in playing a role in moving that value. With our data sets, we did go external and decided to use OECD website data sets over the provided ones. And that's just kind of where we focus. So that could be something in further research that we would look into.
Great, thank you.
If you could go 2 slides back, please. Yeah, so on this chart on the topmost right, which metric would you consider to justify your position if you want to invest in Germany? But take only that metric which has similar flow of direction for both US and Germany. Like for example, nominal GDP, it's going towards the right for both US and Germany. So justify your position with any of those metrics which has similar impact.
Our main focus would be to look at the GDP. If you're looking at the GDP per capita, they're very close in it. But to answer your question directly, the 3 that move in the same directions help the USA in their argument. And our focus for Germany would be the ones that actually go away from that and where they differ. And where Germany shows a balance, US shows aggression, especially in fiscal. So that was more the focus defending our argument rather than the 3 that would show USA as positive.
And so what Joel's talking about is the institutional and fiscal scores. And that's kind of the long-term thinking that we wanted as commercial real estate investors to prioritize. And so seeing the US being below average compared to other OECD countries in these metrics is a key risk to us and one that we weren't willing to make.
Are these metrics related to each other?
Sorry.
Are those metrics related to each other?
In which way? So the governance scores are independent. They're sourced from the World Bank, and they rank 2 different things. The power of an institution, like politically, to act accordingly and impose their judgment, I believe. And then the judiciary score is within, is to properly prosecute and ensure trust within their system. And so then on debt, yes, they are related, but there's 4 different ways to look at debt in what we believed. It was debt to GDP, debt to revenue, and then interest, so you can see the affordability of their yearly interest payments.
Thank you.
All right, thank you, University of Waterloo. Last group for today is SUNY New Paltz.
We have to use the mics? Do we have to use the mics?
Yes, they're connected to live stream.
Understood.
Yep.
Thank you. Good to go. Hello, judges, teams, and Manhattan University employees. Thank you all for being here and making this event as great as it is. My name is Pablo. I'm here with my colleague, Lana. We're going to be going over macro debt conditions, economic dynamics in the US versus Germany. So to look at this, we use both top-down and bottom-up approaches. Top-down, looking at long-term persistent effects of variables that impact government debt. Now, we couldn't just look at these two countries within our model because it would leave us with very little observations. So we used clustering to identify countries with similar macroeconomic profiles to the US and Germany, and then went on with our analysis. And then from the bottom-up perspective, we went from the micro up to the macro, simulating these two different economies via agent-based models.
So here we implement a panel OLS regression. This is a great method for controlling for variation between countries. We also tried a vector autoregressive and an autoregressive distributed lag model, but this allowed us to put more predictors and for them to have higher significance. So our main finding here is that government debt is highly persistent. In other words, fiscal inertia is strong. Once these countries accumulate debt, rollover obligations and gradual policy adjustments make it very difficult to adjust course in the short run. Now, another finding that really stood out to us was that exports raised national debt and that imports lowered. So while this might seem counterintuitive at first glance, our K-means clustering algorithm revealed a very interesting structure. So it identified 7 export-heavy countries that rely, basically what they do is they run large export surpluses and reinvest them into public programs, things like infrastructure and social programs, and that increases debt in the short run through counter-cyclical fiscal policies. So the import side comes in, and these countries tend to underinvest domestically or consume mostly in the private sector, so their impact is less pronounced. Now, this analysis is supported by dual dynamics in level and lag unemployment and social spending. So what I mean by this, at level, unemployment and social spending raise the debt burden. But when they're lagged, they reduce it to well-targeted social investments and labor projects. They lower debt for these countries in the long run. Now, moving on to the impossible trinity. The idea here is that no country can simultaneously have all 3 of these things. They cannot have a free flow of capital, fixed exchange rates, and independent monetary policy. So Germany's trade-off here is that they give up their independent monetary policy, and the United States trade-off is that they give up their fixed exchange rate. Now, moving on to our major policy differences. So Germany's debt philosophy is ortho-liberal conservatism. So the way this manifests in their fiscal policy is through the debt rate. So they limit the annual federal deficit and how much they can add onto it to 0.35% of the GDP. And they also prioritize budget surpluses, which we observed in Germany from 2015 through 2019. Now, the monetary policy, again, is where the cutoff comes through. So they follow the European Central Bank policy, and that limits their domestic control. And basically, the idea here is that the European Central Bank must respond to the entire Eurozone, not necessarily just Germany. So Germany's objectives are not only their objectives. Now, in the United States, our debt philosophy is Keynesian pragmatism. So here in that fiscal policy, the way this manifests is large-scale stimulus spending and tax cuts. There's no formal balanced budget requirement, which also causes chaos fiscally for us every couple of years. Now, our monetary policy is where the United States shines. So this is controlled by the Federal Reserve, which is an independent unit within the United States, independent agency, and they have the power to implement quantitative easing and tightening and set near-term interest rates to stimulate our economy when this is necessary.
Now, what are agent-based models? They're a bottom-up simulation, models built from individual agents. In our case, it's going to be firms that are heterogeneous, so they're all different. There's a random component where they're bounded to realistic values. And they capture the randomness of real-world decision-making and the system-wide effects that emerge from simple micro-level interactions, things that are really hard to model with traditional macroeconomic techniques. So they're especially good at feedback loops and nonlinear dynamics, which is why they've been used by the Federal Reserve and the Bank of England as of recently to look at the impact of interest rate hikes as well as liquidity constraints.
Now moving on to direct cyclical graph. So this is for our United States ABM. So there's quite a few relationships here, but I'm going to walk through the most important one for our analysis, which is the debt to GDP, which raises our inflation rate, which causes a revenue shock, lowers the liquidity ratio, and raises the probability of default. We also included QE and QT policy in this quantitative easing and tightening because this is a very important tool for the Federal Reserve. It is secondary to the federal funds rate movements, but it is important, and it's important to include in our model.
Now, these are our model assumptions. They are essentially classical micro and macroeconomic assumptions with some creativity with the confidence penalty, which is like firm sentiment, as well as firm default probability here. Equation number 5 is specific to the United States, and then number 6 here is specific, the Taylor rule is specific to the Eurozone here in the ECB. This is what our model looks like. So our z-axis here is the number of living firms in the economy. With this visualization, we're able to see pockets of the economy that firms might thrive in, and where firms might not thrive in. It's a little hard to see here, but if we look at the cross-sectional, we look at inflation, interest, and then inflation and debt, we see that the slope of inflation is steeper than the slope of interest on its own, and the slope of inflation, again, is steeper than the slope of debt, and then interest has a bit of a steeper curve as well than government debt does. But this is cross-sectional, and it's kind of hard to tell what directly really impacts it and where these loops kind of go, what those pathways look like.
This is into our behavior graph, so this is the stochastic measure. Here we model debt to GDP, different levels of that, and how that influences endogenous inflation. Endogenous refers to inflation that arises from within the system rather than external shocks. So the main finding here is that the higher we go with debt to GDP, there is a non-linear effect on endogenous inflation. So this structural weakness compounds over time and becomes this sort of vicious cycle. So the main takeaway here in the United States is that debt is not the main transmission channel to macroeconomic fallout. It's rather the inflationary pressure that creates and puts on firms, which raises their probability of default.
Now this is our direct cyclic graph for the German ABM. You'll see there's kind of like two components to it. The first one being the ECB, the European Central Bank, and the second one being kind of the firms within Germany. They still have that revenue function here. Just for brevity, it's skipped over, but it's a similar idea here. Now, we see that the ECB is really going to be dictating firm health within Germany. There's a bit of a feedback loop coming from the German economy into inflation, and then, if inflation goes up, the ECB will then increase rates. However, they have to look at more than just Germany. They have to look at, there are over 20 countries that the ECB looks over. So this government debt going into inflation is more of like, it's like the ECB maybe preemptively raising rates if the sentiment from Germany increasing their debt might decrease that sentiment. This is what that ABM looks like. You'll see a few differences. You'll see a few similarities here. Inflation, you'll see, is the highest driver. And that makes sense, similar to the United States. Interest and government debt have less of an impact on firm health than they do in the United States, probably because this is not linked to the actual European Central Bank. If you look really closely here, you will see that interest does have a bit more of an impact, and you can see that kind of by the colors. So the back right is going to be a little bit darker as it goes down on the inflation and interest graph than the government debt, but it's slight. It's worth noticing, though.
These are references, and I'm going to include a few points here as well. So first off, you might notice that we did not include an endogenous inflation graph for Germany. This is again because their monetary policy is not under their own control, so it wouldn't make sense to model different debt to GDP levels and how that impacts endogenous inflation with them, especially because they are so export heavy. The majority of their inflation comes from external shocks. Now, for our final recommendation, we would recommend investing into the United States. So while we do lack some fiscal conservatism, we have excellent support systems with the Federal Reserve and monetary policy that allow a lot of protection for firms and consumers in this country. While Germany does offer steady and slow growth, they do not have control over their monetary policy. So in this uncertain global environment, in the case of economic uncertainty or risk, they are not able to respond in a timely manner. So our recommendation is with the United States. Thank you very much. We'd be happy to answer any questions.
Question? Thank you.
Can you elaborate what exactly did you get from the bottom up and from the top down models, and like how it informed your decision or recommendation?
Sure. So from top down, that's going to be kind of a panel OLM looking at the long-term impact of, what drives inflation up or down within these countries. What drives debt down, up or down. And then the bottom up is looking at the firm level, looking at firm health, how, debt, the causal pathway here is kind of like a higher level of debt might increase inflationary pressures, which will then cause, some central bank to possibly increase interest rates. So that was our idea with the agent-based model here from the bottom up, seeing kind of how that impacts the stability of the entire economy. economy. We're using firm health as a proxy here for living rooms.
One follow-up question. You showed us the panel OLS. Do you also have results for the k-means clustering?
The results for the Canadian clustering, I believe we ended up with 3 clusters, and it included 7 countries. They were mostly Nordic. So there's Switzerland, Denmark, Sweden, Austria. We have the United Kingdom in there for match the United States. So mostly Nordic.
So Germany and the United States were in the same cluster?
Yes, they were. Yeah.
Okay, thank you.
Well, just a follow-up question. So which method of the clustering for the k-means, like how did you evaluate the optimal number of clusters?
We use a street plot.
Okay.
Yeah, we use a street plot. It wasn't super telling which one. I believe we were between, it was between 3 and 4 clusters. Yeah, it was between.
Okay.
Okay, first of all, thank you so much for accepting previous round judges some suggestions at the end of your presentation. And I have a quick question on your very beautiful animated graph. So I understand why, so you already explained why you apply this ABM and how to interpret this one, but it looks like still, because I have no knowledge on this. So could you please elaborate more on how to interpret this graph in layman's term?
Sure, yeah. So each motion is a time step of the simulation. Within this graph, it doesn't tell the full story because there's a lot of endogenous behavior in here. So you need to kind of look more within a time series view like we did later with the endogenous inflation. But here we're kind of looking at stress testing the economy. So we have various levels of inflation. We have various levels of interest, and they can get pretty extreme, and they can be pretty mild as well. So it's like you see where the firms die out first, and it gives you an idea of what stresses firms the most, what might stress the economy the most, and you can see where the pockets of good economy may be. And going into this, do Germany and the U.S. have different pockets? Is there a better place for for them to be fiscally, essentially, firms to do well? That's kind of the idea behind it.
Okay, thank you so much.
So no question, just a recommendation on this. So would it have been more sensible to use inflation and interest ABM United States versus Germany so that we could see the impact in real time for each step function, how your position is justified that US is performing better when it is a stressed economy rather than Germany? Like just a suggestion, yeah.
Thank you so much, all presenting teams, faculty advisors. Let's give one round of applause to your faculty advisors in the room. And also one more warm thank you to the judges for taking the time out of their busy schedule to be here today with us. We have some small gifts for the judges. Nika, Janju, Nikki, Bill, Sagi, and Paul, thanks again. And also one more thank you to our camera crew and live stream crew, Dr. Said Kazmi, RJ, and Ben. Thank you, guys. Again, the video will be available on the YouTube channel of the O'Malley School of Business afterward if you want to refer to that video. I'm going to conclude with just a few announcements. Unless the team is staying tonight, checkout is from 4 to 5, or basically you need to be checked out by 5 o'clock. Just make sure to get your stuff and stop by the front desk to return the room key. That has to be done before 5 o'clock. Then dinner and the awards ceremony starts at 5 o'clock in room 5B. you know, whether you were a finalist or not, there will be recognitions of the best posters and the prizes for the top team. So make sure to attend the dinner and the award ceremony. And the last thing is the score. The average score that you will get is a combined score of phase 1 and phase 2. So the score that you got in the semifinal round, that will be discarded. What you got from the poster presentation and this round will be used toward determining the the winners of the cash prizes. So any questions, any thoughts, comments, all good? So if you could please step out of the room, there will be a judging deliberation and we'll see you at 5 o'clock. Thank you.
Want to do it? Yeah, I'll take care of it. They're weird.
No, I think
I'll take. Oh, you got it. Okay, cool. I couldn't get them before. That's good you got them. Do you need anything else from me before I go back to Aileen?
No, unless the judges need anything.
All right, good evening. Oh, good evening, everyone. Welcome back. I know you're enjoying your food, but it's time to start the last finale. Uh, sorry? I'm not sure. They are supposed to be here by 5. 4 minutes.
They just started eating. Shouldn't we wait for the award ceremony?
Well, we cannot push it back anymore.
Well, but we have from 5 to 7 for dinner. Like, I thought we we're gonna do the award ceremony right away.
That's what I thought, no?
I think we need, I don't know if everybody's checked out. Are all the teams here?
So the other St. John's, Waterloo, California, Manhattan University. I'm not sure what the others.
Yeah, but, okay.
Yeah.
Okay, we said 5 to 7 dinner. I didn't think we were doing it right at 5, but maybe I'm wrong. You think we should do it? We should do it. That's fine. Then we'll be done. It's fine with me. I just thought it was a little early. It's up to you. I'm sorry. I didn't mean to run.
It's your call, because I already said that we are going to start
Yeah,
at 5:10.
Let's start. Yeah. Okay.
I'm back. So we are going to start our awards ceremony. So the first, thank you for your hard work. It must be a very exhausting day, but you did great. So let's cheer ourselves. Now let me introduce our Dean Gergius of the UMass School of Business at Manhattan University.
Thank you. Good evening, everyone, and welcome to our dinner and award ceremony. Today, we celebrate the achievements, dedication, and excellence of 20 teams participating in our 10th competition. I would like to congratulate all the teams for their great presentation and posters over the last 3 days. We are impressed with your passion and hard work, and you are truly the future AI and data analysis leaders, and we are so honored to have you at Manhattan University. To our judges, we appreciate your expertise, time, fairness, thoughtful evaluations, which ensure that our awards reflect the impressive achievement of the competing teams. Our judges, please rise to be recognized. I don't know how many of them are still. Good. A big thank you to the O'Malley School of Business Analytics Competition Committee, led by the chairperson, MJ Kim and Horan Deng. I would like also to thank Professor Anabi and Professor Messasis for their support. I would like also to thank the incredible team of student workers led by John Howard and my beloved Associate Dean, Professor Fairley. I don't know where she. Thank you for all of your work. I would like also to thank the Business Analytic Conference donor, Nick Tomasieno, our keynote speakers, David Solganik, and the Kelly facilities staff and government staff. I think it's time right now to announce our team winner. So we start with our posters, and they are organized alphabetically. First one, Fairfield University. Please come.
Yeah, please come. First, they didn't take the pictures by themselves, and then you can join. By the way, for the best the posters, you are going to receive the plaque. we are going to order after today, so I will reach out to your advisors.
Next, we have Ramabo College University.
Ivy, come forward and take the pictures for. You will talk. I will reach out to your advisor. Okay.
And the third team is Trinity University.
Your team won again.
And the last team is University of Kansas. Good. Next, our 2025 Business Analytic Competition third place winners will receive $1,000 award, and the winner is St. John's.
Logo. Oh, okay.
What's the second, right?
It was easy to figure it out last time.
Oh, yes, yeah.
Oh, sure. Yeah, okay.
And the second place winner will receive $2,500, and the winner is St. Mary's College.
Bridget just arrived. Bridget.
Oh, yeah, yeah.
The 2025 Business Analytic Competition first place winner will receive a $5,000 award, and the winner is University of Waterloo.
That's music, I guess.
So is there anything else?
No, that's it.
Okay, this would conclude our competition. You guys can stay and enjoy the rest of your dinner. Thank you so much for coming to Manhattan University.
Please enjoy your food and congratulations to winners. And actually, everyone did great work.
Yep, done. Where's William? William is supposed to turn on the music again.
Yeah.